Today, silver fell to $73 per ounce, a level unseen in weeks, hitting this point in a single session on a day that caught most off guard. If you are tracking the price and questioning the sudden move, the usual explanations miss three critical factors that shape the next 10 days. The first event behind today's shift is Moody's downgrade of the United States government on May 16th, reducing the rating from PEL AA to AA1. This makes Moody's the final major credit agency to strip the U.S. of its perfect top-tier rating. Fitch did so in 2023 and S&P in 2011. Currently, no major agency maintains a perfect sovereign rating for the United States. Mainstream coverage frames a U.S. credit downgrade as long-term bearish for the dollar and bullish for real assets like gold and silver. While directionally correct over the medium term, that perspective misses a key detail. When such credit events trigger institutional rebalancing and margin requirements, the first response is rarely rotation into gold and silver. The most liquid assets are sold first. Gold and silver rank among the world's most liquid assets. The decline to $73 reflects forced liquidation, not a fundamental judgment on silver's value. The second event influencing the market is ongoing U.S.-Iran negotiations regarding the Strait of Hormuz. Bloomberg reported on May 11th that the two sides remain far apart on a deal. Reuters confirmed on May 5th that Trump paused escort efforts while no signed agreement existed. The New York Times reported on May 7th that both governments were evaluating a one-page interim framework, with 3 senior Iranian officials confirming active direct talks. As of May 19th, no deal is signed, no ceasefire is official, and the strait remains contested. Oil prices continue to reflect geopolitical risk, inflation expectations stay elevated, and the Federal Reserve cannot reduce rates in this environment. Positive statements temporarily ease the geopolitical floor for precious metals, while stalled talks restore it. This back and forth has contributed to the wide intraday swings for silver in May. The next 72 hours will hinge on official government announcements, either removing or reinforcing this risk premium. The third factor, largely unreported, involves physical silver supply. According to Gold's AI warehouse data, the COMEX registered silver vault holds 80.9 million ounces, the quantity deliverable against futures contracts. The June 2026 silver contract still has 30,061 contracts open, representing 15.3 million ounces of potential delivery with 8 days to first notice day. The delivery coverage ratio stands at 15.7% within the tight zone, while the formal stress threshold is below 15%. The paper leverage ratio is 6.4 to 1, meaning for every 6.4 ounces of paper silver claims, there is 1 ounce of real registered metal in the vault. The COMEX stress index reads 42 out of 100. May 2026 contracts have already seen 5,628 contracts stand for physical delivery, totaling 28.1 million ounces of real silver withdrawn from the registered pool. Today alone, 123 contracts took delivery, removing 615,000 ounces from the system in a single session. Against this backdrop, the $73 paper print reflects forced liquidation rather than the activity in the physical delivery market, which continues to operate robustly beneath the surface. The structural outlook remains unchanged, regardless of what any single session on a price chart indicates. Reuters confirmed in April that the global silver market deficit is expected to reach 46.3 million ounces in 2026. This marks the 6th consecutive year that global silver demand exceeds mine supply. HSBC updated its 2026 silver price targets as recently as May 14th and projected a global deficit of 73 million ounces for the year. The solar silver demand story is more complex than most channels suggest. PV Magazine reported in April that silver demand from the photovoltaic sector is forecast to fall 19% in 2026 as manufacturers reduce silver intensity per panel. This represents a real headwind. However, the Silver Institute confirmed via Reuters in February that physical investment demand is expected to rise 20% in 2026, reaching 227 million ounces. AI data centers, electric vehicles, defense electronics, and high-speed transmission infrastructure are absorbing much of what solar demand is reducing. Total industrial silver fabrication is forecast to fall only 2% overall. The 6th consecutive annual deficit is structural. A 19% decline in solar demand does not close a 46 to 73 million ounce annual supply gap. It narrows it slightly while every other demand category grows, and physical investment demand is projected to increase 20%. A paper price drop to $73 in a single session cannot coexist as a permanent truth with these structural fundamentals. One of these data points must adjust toward the other. The gold to silver ratio currently changes the arithmetic across the market. Gold trades near $4,050 per ounce with silver at 73, putting the ratio near 62 to 1. The 5-year average sits near 80. The historical long-run average through the 20th century is about 47 to 1. JP Morgan published a formal 2026 gold price target on May 18th, confirmed by Reuters. Their average target is $5,243 per ounce, with year-end projections approaching $6,000. If JP Morgan's base case unfolds and gold reaches $5,243 while the gold to silver ratio compresses to the 5-year average of 80, silver would price near $65, below today's session. If the ratio normalizes to the historical average of 47-1, silver at a $5,243 gold price implies roughly $111 per ounce. No squeeze or extraordinary event is needed. Directional correctness on gold and ratio normalization accomplish the rest. The current ratio at 62-1 is already below the 5-year average of 80, setting the direction for repricing in this cycle. The $73 session print represents either a buying window within this broader move or pause before the next leg. Vault data and physical demand projections indicate which outcome aligns with real market activity. Investing. Com published analysis on May 19th describing silver's current pullback as a tactical opportunity, not a trend break. A separate technical piece the same day uses the VC PMI indicator to signal a bullish expansion scenario, targeting 84.57 in the near term. 2 independent institutional analyses on the same day as the $73 session classify the move as a floor and opportunity. Physical vault activity with 615,000 ounces delivered today conveys the same message in practice. 3 scenarios define how the May 19th to 29th window may resolve. Scenario 1 is macro clarity recovery. Moody's-driven liquidation resolves within 48 to 72 hours as institutional rebalancing completes. The dollar stabilizes and resumes its year-to-date downtrend. Iran negotiations continue without resolution, maintaining the geopolitical floor. Silver recovers from $73 toward $79 to $84, while June first noticed day vault mechanics add physical demand to an 80.9 million ounce registered pool, running a 15.7% coverage ratio with 8 days remaining. The Conch Stress Index rises from 42 toward 60 as delivery activity builds. Multiple positive catalysts operate simultaneously for all holder types in this scenario. Scenario 2 is extended pressure. Moody's-driven dollar strength persists beyond the typical 48 to 72-hour window. Iran negotiations produce a preliminary announcement removing the geopolitical floor before physical demand mechanics intervene. Silver holds $72 to $75 without meaningful recovery above it. This is not a scenario that erases the structural deficit confirmed by Reuters. June first notice day vault mechanics remain intact. The paper price simply takes longer to reflect what the physical market already knows, providing a longer timeline at lower prices for those aware of their holdings. Scenario 3 is surprise override. A breakdown in Iran negotiations pushes oil higher, locks in the inflation narrative for another quarter, blocks any near-term Federal Reserve rate cut, and generates a gap open in precious metals, reversing today's session in a single day. This scenario produces the largest moves, where prior positioning dictates outcomes. A Scenario 3 event cannot be timed. You're only present when it unfolds. Each type of position carries a distinct setup for the next 10 days. For PSLV holders, the key metric each evening is the discount to net asset value. PSLV stores its silver at the Royal Canadian Mint in Ottawa, fully allocated, fully segregated, and not lendable. When paper silver drops sharply in a session, PSLV shares can trade at a wider discount than the underlying silver move, as retail selling pressure on ETF shares outpaces NAV adjustments. When that discount compresses, holders gain from the compression alongside any spot price recovery. Track the PSLV NAV versus share price gap each evening through May 29th. Discount compression and spot recovery operate together. This is PSLV's structural advantage in a window like this. For SLV holders, golds. AI data shows the SLV New York Vault holds 85.2 million ounces of physical silver. The metal is accounted for and available for execution in this window. The tightest bid-ask spreads occur between 8 a.m. and noon Eastern Time. The first 15 minutes after the New York Open in a volatile session can have meaningfully wider spreads than the spot chart indicates. AGQ holders face a session environment where daily leverage decay works against them, irrespective of where silver closes. AGQ requires 3 to 5 consecutive sessions of clean, sustained directional movement. A catalyst for this trend is the DXY falling below and maintaining under its 52-week low. Watch the dollar index before the silver chart tomorrow morning. Physical silver holders retain ounces whose value did not change during this session. No algorithm affected your stack. Reputable dealer premiums did not instantly adjust to $73. Paper prices and physical holdings are not identical. Today demonstrates this distinction clearly. For members, the June First Notice Day War Room is live. It contains session-by-session vault thresholds, open interest countdowns with daily triggers, the full scenario map with vault and price data for each outcome, and evening updates within 2 hours of COMEX warehouse reports. The most important habit between now and May 29th is to check the registered silver vault at Gold's AI after each daily COMEX warehouse report. The baseline is 80.9 million ounces. Record it. Check again tomorrow evening. Paper charts show paper activity. Vault numbers show physical activity. When the two diverge, one reflects the market truth, the other does not. Today, paper dropped to $73 while 615,000 ounces of physical silver were pulled from the vault. These events occurred simultaneously. By the time you see this, silver is moved. Market numbers are live and differ from those at recording. Drop the current live silver price in comments, noting your location. This thread becomes a real-time tracker for the next 10 days, keeping the community connected as this window unfolds. All data points are verified. Confirm them independently before acting with money. The paper price fell to $73 today. At the same moment, 615,000 ounces of physical silver were delivered from the COMEX vault. Coverage ratio sits at 15.7% with 8 days to June first notice day. The 6th consecutive annual deficit is confirmed. The paper market and physical market are telling different stories. Watch the developments. The vault update will provide clarity this evening.